This video is sponsored by investing.com. Europe really does have some very exciting startups. Take Lovable, headquartered in Stockholm, or Lagora, also based in Stockholm, or even 11 Labs, with its global headquarters in London. And they all have something in common: European founders, European teams, and European headquarters. But the thing is, legally, they're actually American companies. They're incorporated in Delaware in the United States. I mean, how crazy is that? And for me, it's kind of strange. Why would European founders deliberately make their companies American? And usually when I talk to people, they say something like, it's Europe's bureaucratic nightmare, it's Europe's legal complexity, or it's a lack of a risk-taking culture here in Europe. But to be very honest, that's only such a small part of the entire story. Because the US has designed a very specific system that pulls high-growth startups towards Delaware. And of course, because this is America, it has to do quite a lot with money. Actually, it has a lot to do with money.
Some of the most high-profile, many of the most high-profile companies that Europe is producing follow that sort of structure of all ops in Europe, but they have a US parent company. And why is this happening? Simply put, it's because that's where the capital is, and capital sets the terms. So US investors control by far the deepest pool of venture money in the world. And they generally want to invest into US companies, and they're incentivized to do so. And we can obviously kind of unpack why that is.
Yes, Tom, let's unpack that briefly. The first problem Tom mentions is one that most of us already know. Venture capital in the US is simply much, much bigger than in Europe. Just have a look at the numbers. In 2025, US VC-backed companies raised around $340 billion. Europe raised roughly $66 billion in VC investment. So, if you're building a fast-growing company here in Europe, there's a good chance that you'll eventually need American investors. And that's where the US has done something incredibly smart, but also incredibly damaging for Europe. It's designed a tax system that rewards investors who back American startups, not foreign ones. And the result is that many European founders don't just raise money in the United States, they literally move their company there. At least on paper. But let's explain exactly how this works through a very simple example. Let's imagine there's a super high potential AI startup incorporated here in Germany. They are doing an investment round, and a US investor is interested in putting in $1 million. Now let's say things go incredibly well, and after 5 years the investor wants to exit, as their shares are now worth more than $15 million. That means they made a gain of $14 million, which is a great deal, right? And yeah, of course, it is. But because this is a German company, the American investor may have to pay federal capital gains tax. And in a simplified example, that is around 20%, which means roughly $2.8 million goes to tax. I mean, let's face it, it really is still an amazing outcome. But nonetheless, almost $3 million is gone. And there is another way. If that exact same startup had been incorporated in the United States, typically in Delaware, the investment may qualify for something called Qualified Small Business Stock, or in short, QSBS. This is an absolutely enormous tax incentive. Let me draw the exact same scenario for you. Same startup, same US investor, same $1 million investment, same exit after 5 years. Same final value, $15 million. But this time, the company is incorporated in Delaware and qualifies for QSBS. Now, the investor's gain is still $14 million, but instead of paying roughly $2.8 million in US federal tax, they pay zero. Nothing. They keep the full $15 million. And that means the investor walks away with around $2.8 million more, simply because the company was incorporated in the US instead of Germany. And because, of course, a foreign company cannot issue QSBS. And that is honestly kind of crazy, because QSBS can apply per eligible investor. The tax savings can become enormous very quickly. Now, unless, of course, you are a Silicon Valley venture capitalist, there's not much you can do about QSBS. But what you can do is choose where your own money goes. Personally, I've been moving my portfolio towards European companies rather than holding American companies. I mean, I'm also kind of patriotic when it comes to that. And that is why I use Investing Pro, the flagship product of investing.com. And the best feature really is ProPicks AI. Let me show you. It scans huge amounts of financial data and uses AI to find companies with massive upside potential. And right now we're looking at US tech titans. So no, we want to look at something European. And we have France here. But we also have Germany. And there's different strategies here that you can choose. Hidden champions in Germany, or also Alpha Germany Select, which I really like because this is companies that are outperforming the DAX index. So when I click on this and I copy it over to my watch list, you can see a list of companies that are worth investing in by looking at this fair value label. So for example, SAP, massively undervalued, and DHL, also massively undervalued. I actually, because of this tool, already bought SAP, and I'm now thinking about DHL. Now, I use this tool a lot myself and find great opportunities. And here's the thing you really don't want to miss. Investing.com is running its biggest summer sale of the year with 60% off. But with my exclusive code EUMadeSimple or clicking on the link below, you can stack an extra 15% on top of that. That's 60% plus 15%, the lowest price you'll literally find anywhere. This offer is only available until the end of the month, so really don't miss out. And check the link in the description. Now, back to the video and to QSBS, the massive tax advantage that's quietly pulling European startups to the United States. And the thing is, the US has made these incentives even stronger. In 2025, Congress expanded QSBS in 3 major ways. First, investors no longer have to wait 5 years to receive any benefit. Hold the shares for 3 years and 50% of the gain can be tax-free. 4 years gives 75% and 5 years gives you the full 100% exclusion. Second, the maximum gain that each investor can shelter increased from $10 million to $15 million, or 10 times their original investment if that's higher. And third, larger startups now qualify. The maximum company size when the shares are issued increased from $50 million in gross assets to $75 million. And these are just not some theoretical tax rules. They literally shape how venture capitalists invest. Take Sequoia, Lightspeed, General Catalyst, A16Z, and many other top venture capital firms. While they obviously actively invest in European startups, more often than not, these companies are incorporated in no other place than Delaware, even though their founders, employees, and operations remain in Europe. Or take Y Combinator, the world's most famous startup accelerator. YC generally only accepts companies incorporated in the United States and Singapore. And in practice, almost all of them choose a Delaware corporation. And yeah, incentives like QSBS are literally a very big reason why. Now, you might be thinking, so what? If European founders want to incorporate in the United States, why is that actually a problem for us? Well, because Europe doesn't just lose a company on paper. It risks losing control, money, and yeah, eventually also talent. First, let's look at control. Once a company incorporates in Delaware, it becomes legally American and is governed by US law. For strategic industries like AI, semiconductors, and defense, that is a massive deal. I mean, just look at Anthropic. European companies have been blocked from accessing some of its most advanced AI models because of US export controls. And that brings us to money. Most startups fail, but the few that succeed become incredibly valuable. And that's where the corporate structure really matters. In many cases, the US parent company owns the intellectual property, while the European company simply employs the team. So, when big profits finally arrive, much of the value ends up in the United States, not here in Europe. Europe might get the salaries, but America gets the intellectual property and a large share of the profits. And third, there's also brain drain. QSBS doesn't just encourage investors to back American companies. It can also encourage successful founders to move to the United States themselves so they can benefit from those very tax rules. And finally, it creates a bit of a cycle. Every founder who chooses Delaware makes the American startup ecosystem a little stronger, and Europe's sadly a little weaker. More capital flows to the US, more success stories happen there, which gives the next European founder one more reason to make exactly the same decision. So yeah, this is obviously a pretty big problem. And the key question is here, is Europe actually doing something about it? Now, if you've been watching the channel for a while, you've probably heard me talk about EUing, and we made 2 videos about it. And in a nutshell, the idea is very simple. Create one European company structure so founders no longer have to deal with 27 different legal systems building a business across Europe. The goal is that you could incorporate online in just a few days for less than 100 euros without having to deal with notaries or piles of paperwork. That sounds great, right? And it will help. But will it actually stop Europe's best startups from moving to Delaware? Well, we asked this very question to Tom about EUing.
I love the energy behind it, and there's some awesome people involved, and Europe needs that sort of energy, right? So the energy is awesome. But I don't think it fixes the problem, right? The problem is the capital. So Europe has all the capital. It's not shifting that capital into private companies, let alone startups, in a way that the US is.
So what actually needs to change? After speaking with Tom and several other European founders, I think there are 3 big reforms Europe should really be focusing on. And the first one is probably the most important: unlocking European pension money.
So I'd implement one of the core recommendations of the Draghi report. So Europe has a ton of pension capital, but that pension capital isn't flowing into private companies, let alone startups / scale-ups. So my kind of the top rec that I'd take from the Draghi report and I'd implement if I was in charge would be to unlock European pension capital.
My God, I really wish the European Union would just take the Draghi report and implement all of it. Anyway though, in the United States, funded pension assets are worth around 142% of GDP. And in Europe, they're only around 32%, and that is an enormous difference. And there's 2 big reasons for this. The first is that many European countries, Germany in particular, still rely heavily on pay-as-you-go pension system. Workers pay in today, and that money is immediately paid out to today's retirees instead of being invested for tomorrow. The second reason is regulation. For example, Solvency II. We have created a system where it's simply easier to invest billions into government debt than into the next European startup. The money does exist in Europe. We're a rich continent. It's just not flowing to the right places. And the second thing Europe really needs is its own version of QSBS. Because if the US can use tax incentives to keep startups, founders, and investors in America, why can't Europe do something similar?
So, maybe another alternative to QSBS, which will just require, all 27 of us to work together to some extent. Maybe as an alternative to that, or in addition, we could just have, a European, something like the Scale-Up Fund, where, the European member states kick money into some shared pot. And there's some, I'm thinking on the fly here, right? I haven't thought about this in the run up to our session, but if there's some way to say that if your company is funded out of this pot, you get tax breaks, irrespective of where you're a tax resident. Something like that, where we could say that hey, this is this really is to back our European champions.
I love that creativity by Tom, and obviously it needs some more thought, but something like that would really help Europe. So, in the end, I don't think Europe has a startup problem. I think Europe has an incentive problem. The US has spent decades building a system that rewards investors, founders, and startups literally for just staying in America. And Europe hasn't really. But the good news is we can do something about this. We can unlock pension capital, we can build deeper capital markets, and we can create our very own version of QSBS. We have such talented founders, we just need to give them a reason to stay here in Europe. Now, one last thing before you go. If today's video made you want to actually act on this and start building a stronger European portfolio, Investing Pro is genuinely where I'd start. You can find undervalued European stocks, run fair value checks, and filter by country or sector in just a few clicks. The summer sale is limited to literally just July, 60% off with an extra 15% if you use my code EUMadeSimple. The link is in the description below. And as always, a special shout out to our presidents who make all of this possible. Your support is awesome. See you in the next video.